So the stock market has reached all-time highs once again just after the news broke out that both the Pfizer vaccine as well as the Moderna vaccine seem to be extremely effective at preventing the disease, this big pandemic that we are all suffering from right now. What this really means for a lot of people, and myself included, is that there's finally some light at the end of the tunnel, not just in terms of our lives and what we will be able to do, maybe in the next few months or year, maybe a couple of years, right? But there is light at the end of the tunnel, and the stock market has reacted in a great way. The S&P 500 has reached all-time highs, and pretty much all stocks are going higher and higher. So with the stock market being so expensive and everything being ridiculously high in price, is there any point in finding stocks that are reasonably valued? Should I just end my video right now and ask you to subscribe and see you later? No. As Chuck Carnevale, co-founder of Fast Graphs, often says, it is not a stock market, but a market of stocks, okay? That means that there's always opportunities to be found. And in today's video, I'm gonna show you three different dividend stocks that look fairly valued. A couple of them actually look pretty undervalued, even in this market, okay? So buckle up. I'm gonna go over, their dividends, their history, what's good about them, what's bad about them. You're gonna love this video, I am sure of it, so let's get started. Personal finance. So if you are new here and if you like what you see, make sure to subscribe just so you can find your way back to my videos more easily, and make sure to give this video a like because I always put a lot of effort into my videos. Now I'm gonna go straight into the video. The first stock that looks pretty good that I bought a few months ago, and I still think it looks pretty good, is Walgreens Boots Alliance. Now these guys own Walgreens, which if you live in America, I'm sure there's one in pretty much every corner out there. At least whenever I've been to America, I've seen a lot of Walgreens, but they also own Boots in the UK. Again, when I used to live there was always a lot of Boots everywhere. Really good shop. I do miss it actually. My girlfriend actually misses it more than I do. But basically, this is a company that has been increasing its dividends for 44 years, okay? Check this out, since 1976. And by the way, guys, if you enjoy this purple magnificence of a screen, this is Dividend Compass. This is an app that I have personally coded because I couldn't find something that did exactly what I wanted it to do. So if you want to really easily find, analyze, and also track dividend stocks, then make sure you give it a go. There's going to be a link in the description of this video, okay? But yeah, guys, as you can see, very good dividend growth streak. The dividend yield at the moment is 4.6%, which is significantly higher than its average dividend yield. I'm gonna get back into that in a second. And it's also got a pretty low payout ratio, 39% payout ratio. By all accounts, that's a really low payout ratio. It means that, should they struggle with earnings, should they struggle with making revenues in the future, that dividend should be fairly well covered, even if they decide to keep increasing it, which with that much of a dividend growth streak, chances are that they will keep increasing it. Now, if we scroll down, I just want to show you the dividend information. I want to show you just how quickly this stock has increased its dividends over the last 20 years, okay, since 1999 all the way up to 2020. Now you can see that the average growth rate, it has been decreasing slightly over the years. You can see that some years, they increase it at like 3.5%. Other years they go crazy and they increase it by like 15-20% every year, all right? More recently, it has definitely been slowing down. The very last dividend increase, which happened this year, by the way, in 2020, was only 2.2%. It's definitely the lowest dividend increase that they have had actually in 20 years. But considering everything that's happened in 2020, considering that, what the economy is doing, it's actually not too bad. It's still a dividend increase, and as a dividend growth investor, that is what I want. I want a company that's going to increase its dividends every single year, regardless of what happens in the world, even if their business is struggling. That's what I want, okay? That dividend growth. And by the way, don't worry about this one. This actually was not a dividend cut. They actually paid a special dividend in 2015, hence the apparent drop, but over that year it was still a dividend increase. Now let's activate the earnings, because I always want to look at the earnings in conjunction with the dividends. The earnings are basically the profits that the company makes. If a company is able to make profits and grow those earnings, every year or in the long run, the stock price is going to follow suit. That is the simplest explanation of investing. If you can find a company that increases its earnings, you're gonna do pretty well in the stock market, okay? So yeah, the really cool thing about Walgreens Boots Alliance is that their, let me deactivate this, the payout ratio has always been pretty low, It was actually less than 20% before 2010. Then it's kind of been increasing a little bit over the years, 40, 30, still pretty low, okay? It's still around 30%. So actually, this year's at 39% is one of the highest payout ratios that they've had in many, many years. And even then, it's still a low payout ratio, which is something that I really like. Okay, so their earnings are really good. Their dividends are even better, okay? That really nice dividend growth streak. What about the valuation? Is it expensive? Is it cheap? All right, let's have a look in more detail. Let's just scroll down over here to the valuation section. And over here, you can see that the current dividend yield is 4.6%. When you compare that to the average dividend yield that this company has had over the last 5 years, it's significantly higher. Let's get a bit more detail into this. You see, it's been steadily increasing because the stock price has been dropping, okay? It has to be said, the market is punishing Walgreens Boots Alliance. It's not liking it too much. Therefore, it's looking pretty cheap. At least if we look at the dividend yield compared to the average dividend yield, right? This actually gives us a price, a fair value more or less of $50, right? And if we look at the PE ratio, something similar happens, It is definitely significantly lower than the average PE ratio of 12. And by the way, this is being brought down by the last, 2 or 3 years of pretty cheap price. If we zoomed out even more, I anticipate that the PE ratio that this company has displayed over the long run is probably significantly higher than 12, okay? So yeah, if you can buy it at an 8.6, which is what you can do right now, to me, that seems like not a bad idea, okay? And by the way, guys, quick disclaimer, I'm not telling you to buy any of these stocks, all right? This is just for information and hopefully entertaining as well. If you enjoy my videos, make sure to click like if you are, by the way, because it really, really helps my channel. But yeah, let's also have a look at what the analysts are saying. They reckon a price of $42, all right? And by the way, the current price is $40, okay? So, these three valuation techniques give you a fair price around maybe $47 more or less. If we do a quick dividend discount calculation on this, let me just quickly check the earnings. They've grown at 10% a year, right? So that's really good. Let's just say that, Walgreens Boots Alliance can keep increasing the dividends at 7% per year, discount rate of 10. That actually gives us a fair value of 67. So that would suggest that it's pretty undervalued, It actually means that even if they keep increasing the dividend at, 6% per year, it still looks cheap, right? So that's basically Walgreens Boots Alliance. Now, the bad part about this company is that it's definitely facing some challenging years. The whole pharmaceutical industry, people going to pharmacies, that's all changing quite a bit. And, they're definitely experiencing pressure from Amazon, from other competitors. So, who knows where the industry is going to be, 5-10 years from now. Having said that, this is a well-run company. This is a company that's been doing what they're doing for a very long time. They are doing things to try and shift the business model a little bit to try and remain competitive, okay? And also, this is a BBB rated company. That is the S&P credit rating, okay? BBB, it's not the best, but it's definitely investing grade, okay? So, it's not going to go anywhere in the next couple of years, okay? This is a pretty robust company. Like I said, personally, I do own this company, and I actually believe they're going to do pretty well in the long run. Okay, real quick, let me just show you what analysts think that their earnings are going to do over the next few years, all right? They actually reckon that they're going to increase quite nicely, So next year, they reckon it's going to be $4.8, then $5.27, then $5.68, okay? That is very significant growth, in the short term, which is something that we should all be looking for. Now, let's move over to the second company on this video, and that is Prudential Financial. I've talked about this company in the past. I personally believe it's one of the best opportunities in the stock market right now. And basically, Prudential Financial is an insurance company, okay? They offer mostly life insurance, and just like with all insurance companies, especially life insurance companies, they've been struck really hard during this pandemic. However, I do believe that Prudential Financial is one of those stocks that should be resilient even more so than other life insurance companies. And you know, this is a company that's very well run. They have an A- credit rating from S&P, which is pretty high. You know, it's definitely something that I like to see. And just have a look at their dividend yield. It's almost 6%, which is really nice. You know, back in March, it actually got to like 11%, which is insane because this company normally doesn't have this high a dividend yield. Now, the payout ratio is also really good, 45%, and the dividend growth rate is sitting at 12 years. They did have to cut the dividend during the financial crisis. I mean, you know, that's not something that makes me look too badly at a financial company, okay? Because that was probably perhaps once in a lifetime event that happened, you know, over 10 years ago, right? But ever since then, it's been increasing its dividend every year. Let's have a quick look at their growth rate. And check this out, right, guys? Even with the dividend cut during the financial crisis, their average dividend growth rate over the last 20 years sits at 11.5. That's really high. And as you can see, they've kind of maintained this dividend growth rate pretty much over the last few years, right? You know, even despite that dividend cut, which, by the way, as you can see, it happened here, right? It went from $1.15, but in a matter of 2-3 years, it had gone back to that dividend. And ever since then, you know, 64%, 26%, 10%, really, really high dividend growth rate every single year. Now let's have a quick look at the earnings, because they do fluctuate quite a bit. You know, obviously the financial crisis was massive, but even then, what's interesting is that they were still able to maintain that dividend very well, very comfortably, yet they still decreased it, which is definitely something that I don't super love. Okay, I prefer a company to be able to at least maintain that dividend, but they did cut it. Okay, however, ever since then, the payout ratio has hovered around, you know, 20%, 30%, right? So actually, yeah, just like with Walgreens Boots Alliance, the current payout ratio of 45% is definitely a lot higher than it has been for a very long time. Okay, let's have a look at the valuation. And just like with Walgreens Boots Alliance, you know, looking at the average yield and also looking at the average PE, it does look undervalued, significantly more so by the yield method, okay? Because the PE, you know, obviously there was that giant decrease during March, but overall it's not too far from its normal PE. So in terms of price to earnings ratio, it doesn't look super undervalued. However, in terms of its yield, it is significantly undervalued. This is normally a company that trades at around, you know, definitely around 3.5–4%. Okay, that's kind of the average dividend yield. Now, analysts actually think that the stock looks overvalued right now. They actually reckon that the target price should be around $67, considering that the stock is now trading at $74. I imagine that analysts are being a little bit careful because of, you know, one, the pandemic, and also the new president, okay, Joe Biden. We still don't know whether that's going to affect the healthcare system, insurance companies, okay, that is still a big unknown, I guess, for analysts and for a lot of people as well. So perhaps that is why analysts don't think that this company is that attractively valued. So using the dividend discount model, you know, if the stock was actually able to grow its dividend by 7% a year, bearing in mind it's done a lot better than that, and with a 10% discount rate, this actually comes up to $157, you know, average value, okay? Which means that it's extremely undervalued. Never look at just one valuation technique, you know, in a vacuum, okay? I normally like to look at several, just like in this case, okay? If we did the average of all three, it's probably around, I don't know, 80, perhaps 80 or 90, maybe. So yeah, definitely looks like Prudential Financial is undervalued. And like I say, I think this is a great opportunity in the market right now. And like I said, this is an A- rated company, meaning that it's high quality, okay? You're not just buying any company, this is a high quality company. Oh, I almost forgot, this is what analysts think that Prudential Financial is going to do over the next few years. They do expect the company to grow significantly, both in 2021 and 2022, okay? That's a tongue twister, isn't it? But yeah, quite significant growth, at least according to analysts. All right, here we go. The third company on this list that I think looks, you know, kind of undervalued, not super undervalued, to be honest, but this actually looks like a company that no one really talks about, but it always passes all my filters whenever I do a screener using Dividend Compass. Again, link in the description. You can start a free trial completely for free, no strings attached. But yeah, Snap-on is an industrial company. They make all sorts of industrial equipment. They do stuff for the automotive, aerospace, construction, and also agricultural industries. That's definitely something I like, you know, really boring stuff, let's be honest. Something that's probably always going to be needed as long as there's cars, agricultural machinery, and planes, okay? That's not really going anywhere. Therefore, a company like this, you know, it is the kind of company that I do want in my portfolio. To be honest, I don't actually own Snap-on yet. I'm kind of waiting for a cheaper price, but let's get into it now, okay? So this is a company that has a dividend growth streak of only 10 years, okay? It's kind of smaller than what I normally recommend, but I'll show you in a second that they didn't actually cut the dividend. They only froze it like 10 years ago, okay? This is a company that yields almost 3%, pretty nice dividend yield, let's be honest, and a very nice payout ratio of 41%. But as you will notice, everything pretty much on this screen is green, okay? I do have my own filters on all these companies, but the P ratio is green, okay? The forward P ratio looks good. Return on equity, debt to equity ratio, interest coverage, okay? I really like to see those numbers being good. And in the case of Snap-on, it kind of passes pretty much with flying colors. I'm just going to scroll down all the way past dividends and valuation, because I want to show you some of the fundamentals and just to show you that this is actually a really high quality company, you know? So yeah, their payout ratio has stayed consistently kind of below 30%. Now the same thing can be said with free cash flow payout ratio, you know, except 2010, 2011, where, you know, it wasn't great, you know, still very reasonable payout ratio. Now, shares outstanding, there does seem to be some missing data here, but there is definitely a lowering trend, okay? Return on equity, definitely over my minimum of 10%. Debt to equity ratio and interest coverage, right? Those two things have to do with debt. And, you know, debt, I always say, is the biggest killer of companies. You want to invest in companies that have as low debt as possible, okay? That means they're not leveraged. That means there's a lot less risk with that company. And what I like to see with some of these companies is this debt to equity ratio actually decreasing, you know? It never was that high in the first place, but they've obviously been working quite hard to improve their balance sheet and decrease that debt to equity ratio. And the same thing goes for the interest coverage, you know? They actually currently own almost 20 times their interest expense, you know, what they have to pay in interest. And that is just covered around 20 times by the operating income. Which, by the way, you know, the operating margin has also been increasing quite nicely. It's above the minimum, and its revenue has also increased over the last decade. You know, so pretty much this company passes a lot of my filters. Fundamentally, it's a really high quality company. It's A- rated by S&P. Okay, so again, you know, they kind of give it a nice big tick. It's not the best company out there, but it's one of the best companies out there in terms of credit ratings. Okay, let's scroll back up and let's look at the dividends, okay? Because like I said, you'll notice that during the Great Recession, they did freeze that dividend for a couple of years, all right? But they didn't cut it. And that's, you know, if a company doesn't have a super long dividend growth streak, as long as they haven't cut their dividend, that's definitely better than if there is a cut, all right? And in this case, you know, they didn't cut it. Also during, you know, the early 2000s, they definitely were not a dividend growth stock, right? They definitely, it looks like they became that from 2010 onwards. And guys, look at those numbers. Look at those double-digit dividend increases, including 2020, by the way, where they increased the dividend by almost 14%. That was actually announced earlier this month, okay? So this is pretty much a sign from management to say, guys, we've got you covered. We're going to keep increasing that dividend. You can be sure that we're going to keep increasing our earnings. You can be sure that we are going to make you a lot of money, dear shareholders, right? That's what I imagine that the CEO said, okay? If we activate the earnings per share, let's have a quick look at, you know, how well they're able to cover that dividend and how well they've been able to cover that dividend in the past. This is one of the most important things that you can do as a dividend growth investor, by the way. This will tell you whether a company is probably going to keep increasing that dividend, right? And just like with the other two, okay, because again, you know that in this channel, I only give you high quality businesses. So if you're enjoying this so far, make sure to subscribe. make sure to give it a nice thumbs up, because that tells the YouTube algorithm that this video is good and it's going to push it to more people. So that, you know, makes me want to do more videos. So definitely do that. But yeah, guys, you know, besides like 2003, where the payout ratio got to kind of uncomfortable levels, slightly uncomfortable levels, 74%. That's basically the only exception, I believe, to an otherwise very good and very low payout ratio history, okay? So yeah, even now, even with the apparent decrease in earnings, this is not finalized, by the way, this is 2020 earnings, it's still got plenty of room to keep increasing that dividend, which is phenomenal, right? Now let's have a look at the valuation for Snap-on Incorporated, not to be confused with Snapchat, by the way. They've got pretty much the same ticker name, but no, this is not Snapchat, okay? I don't buy Snapchat, I'm not buying Snapchat. This is Snap-on, all right? The dividend yield is slightly higher, actually pretty nicely higher than its average dividend yield, you know. This might be a good opportunity to buy this company. However, the PE ratio, it is slightly higher than it normally is at, okay? So, you know, it's not super expensive, okay? It's like 16 versus 14. And by the way, this is the forward PE ratio, okay? So using analyst expectations about where the earnings is going to be in the next 12 months, okay? But yeah, guys, let's have a look at the analysts, okay? They reckon a fair price of 165. It now trades at 170. And just to do a quick dividend discount model calculation, let's have a look at the earnings per share. You know, they've grown at 14.4% per year over the last 10 years, all right? If we add quite a solid margin of safety, okay, let's assume that it's going to keep increasing its dividend for, you know, by 8% per year, which, as you can see, is a very significant margin of safety. Let's say 8%, let's put that here. Let's keep the discount rate at 10. And that actually gives us a fair price of $233, right? It's not too far from the yield method calculation, but it's quite far from what the analysts say, as well as the PE ratio calculation. So, you know, the average seems to be, I don't know, I'm just doing quick maths in my head here, somewhere around $200 perhaps. No, maybe like 190, right? So, you know, it does look like Snap-on could be slightly undervalued at the current prices. However, like as we've just discussed, this is a high quality company that, you know, to be honest, I will buy it at some point, I'm pretty sure. I just normally like to see, you know, companies struggling a little bit, people kind of selling out of a company before I buy it, right? That's kind of my own strategy. And I just want to lastly look at analyst forecasts for this company, okay? Check it out, 2021, 22, 23. They reckon that this company is going to keep increasing its earnings at quite a nice rate, all right? So yeah, guys, those have been 3 companies that I think look pretty undervalued. They're all really good companies, as you've been able to see, even if it's just by the credit rating, right? Really good companies at pretty attractive values. So yeah, guys, hopefully you found a lot of value in this video. Let me know if you'd like me to keep making these videos, you know, perhaps once a month. I'll just go in there, jump into Dividend Compass, which I'm still developing. I'm still trying to make it the best tool out there, you know, so that my customers get the best out there in terms of dividend growth investing. Yeah, guys, make sure to subscribe once again. I appreciate you watching this video. I hope you've really enjoyed it. I hope that I've made your day a little bit better. I hope so. Yeah, guys, that is it from me for now. I'll see you in the next video. Okay, take care. Bye.